Into order at 10:30 a.m. Those present is Alderman O'Brien, Matty Gregg, Dan Hudson, Matt Doobie, and Mary Woods. First thing on the agenda is our visitors, RBC Wealth Management. So Eric, you want to introduce your group?
Yeah. Thanks for having us. So the four of us, starting at that side, Mike Wynn, Jackie Khanna, myself, Eric Stubbs, and Enrique Hine. So we're the team that is managing the pension fund, backed by dozens of people inside RBC.
And that started around 2015?
Yeah, I think so, yeah.
Okay, I forgot to mention Joanne is also present. Okay, do you want to go over your...
Yeah, so I'll go over the beginning. So we have a few things planned for you today, if it's okay. We'll go over the short one-pager, then dig into some of the details on top of that. Then I'll talk a little bit about what's going on in the economics of markets these days, which is, every year is unusual, but this year is also unusual. And then ask Enrique to take it for a few minutes. We did a study for you on how the plan compares to other municipal plans. So we'll go over that. And part of that is we also included a copy. We didn't do it, but we included a copy of your actuarial report, just basically as a reminder and just background information. So if you like, Enrique can go over that as well. It's mostly just as background for you. So the first thing I'll do is there's a June 30 short report. And it is just a format that summarizes some of the important numbers. So as of June 30, the plan as a whole contained $58,873,000. At that point, 68% of it was in the equity account. There was also a little cash in there, so the equity portion is a little bit lower than that, and the rest is in fixed income or cash as well. So for the fiscal year to date, which ended June 30th, the plan as a whole was up 10.77%. And for the quarter, so this was the last quarter, the second quarter of 2025, it was up 6.95% in that quarter. So if you recall this year, mostly because of what was going on with tariffs and uncertainty, right at the end of the first quarter, you had a dip in the market, and then it came back in the second quarter. So that's what you're seeing right here. And the numbers that I think are more important from the standpoint of the long-term health of the plan is probably the three-year number. So on a three-year basis, the plan's been up 13.04% per year for the 3 years. And at the end of the quarter, the little chart at the bottom, the actual equity component was 65%. And if you recall, if you go back to December, it was pretty close to 70% at that time. And 70% is the ceiling on what the investment policy statement allows. So what we did was we actually scaled that back, and I'm going to get to that in a little bit more detail in a second, but just to preface it a little bit, we actually scaled it back dramatically in the first quarter from about 70% to about 62%. And then when it looked like the market was adjusting to the possibility of tariffs and so on, we ramped it back up to 65%. And as we'll see in a second in the more current report, it's actually now, because of appreciation, about 66% in equities. So that gives you a sense for where it is. During the fiscal year, about 955,000 came out of the plan. And the cash at the end of the fiscal year was about $2.77 million. And that cash is not sitting earning zero, it's making about 4%. So even as cash, it's making a decent return. So that's the short version. There's a longer report, and I'm looking first at the one that's dated June 30th. And I just want to highlight a few things in this.
What's that look like on the cover?
It's portfolio.
Yeah, so it's the portfolio
Right.
review, but it's the one period ending 6/30. And then I'll talk briefly about the other one, which is more up-to-date information. But just to cover the order. So all of this is consistent with what you just saw there. So the first thing I'll ask you to look at is page 4, kind of gives you a time-lapse photograph of what's been happening with the plan. And here, I think looking at the 3-year and 5-year numbers is the thing that's more significant. So if we look at the 3-year number, for example, at the start of that 3 years prior to that quarter, the plan was at about $45 million. Since then, about $5 million has come out, and it's appreciated $18.85 million. So that's how you get to the 58.8. If you look at page 5, that tells you a little bit about the asset allocation. So within, in the right-hand little circle chart, you can see that U.S. large cap is the biggest component. That's about half the plan assets are in U.S. large cap. That's worked out well for the plan because, as we know, U.S. large cap's done pretty well for not just a year, but over the last 5 or 6 years as well. Then the next biggest components are bond components as well. And there's a little bit in international as well. So that gives you, at a high level, a bit of the background. Page 6, usually we don't cover this because it's kind of a boring chart. It's a little less boring this time. So if you look way over at the right-hand side of those bars in page 6, what these bars are is they're the components of the portfolio over time. So the dark blue is the equity component, the mustard color is the bond component, and the green is the cash piece. So the important thing here is you can see that the equity component has been pretty consistent over time. It's edging up a little bit, mostly because of appreciation over time. And then suddenly, in the first quarter of this year, you get that drop. And that drop is when we took money out of the equity side, and that was because of what was going on in tariffs. And then when it looked like the economy was adjusting one way or another to the tariff concerns, we started to put it back into the market. So you see the drop, and then it's coming back in. And the drop, if you look up above, the drop went entirely into cash. So what we did was we took it out of equities, kept the cash, and then put the cash back in the equity market. I think at the bottom, we went from about 70% equity to about 62% equity. And then now we're back to about 65, 66% equity. So that was the time path there. If you look at page 7, you've got a little bit more detail on the performance over time. The numbers are consistent with what you saw on the one page. The 1-year number, which is the fiscal year, is 10.77%. It's about the middle of that table. And the 3-year number is 13.04% per year. I think in terms of what else is important to know about the plan, I'm going to fast forward to page 14, where we start talking about the bond side. And 2 things are important here. The first one is the credit quality of the portfolio. The reason you have bonds in a portfolio under the current circumstances are that you want kind of an anchor in the pension fund, so that, when stock markets are going up and down, you want a piece that's not going up and down under normal circumstances, and that's a bond piece. And the downside of the bond piece, if you look back, 5 years, bonds were making about 2% a year, and the bogey in the plan is 7% a year. So if you have a lot of bonds, you're never going to keep up with your bogey. So you need equities to do that. On the other hand, bonds are stable, so there's a reason to have them there. The good news is after 2022, when the Fed started raising rates, what we could make on bonds also increased. So now, rather than making 2% on bonds, we're making 4.5% bonds. It's still not the 7% bogey, but it's a lot closer. So that's really helpful from the standpoint of the plan. In terms of credit quality, there's not a lot of additional yield to be gained by going into lower credit quality. So we stayed pretty high credit quality. 80% of it is basically U.S. Treasuries and agency paper and things like that. And essentially nothing is less than A quality in the plan. And the reason is because, you could go to triple Bs, but you're making, 0.25% more by taking that risk. And it just seemed to us that if the purpose of the bonds is kind of an anchor in the portfolio, the point is not to take risk with it. The one thing we did change and change dramatically over time is on the maturity distribution. So if you think back to a year ago or 2 years ago, most of the bond money was in 3 years and less. And that was because you made about the same amount of money on short-term paper as you did on long-term paper, but without risk, because it wasn't going to change on you. So back then, we had a lot of the money in short-term money. What we've done since is moved out the yield curve so that now most of the money, more than half of the money, is between 3 and 7 years. And the reason for that is because of a couple of things. One is if interest rates were to come down, being further out the curve, you're probably going to make a little bit more money on the bonds than you would on short-term bonds. So we went out further because our feeling, I think, as with most people right now, is at some point in the near future, the Fed is going to start lowering rates. That doesn't necessarily mean that longer-term rates will come down, but they probably will. And the two factors that determine whether longer-term rates come down in that environment are, one, what do people think inflation will do? And two, what do they think the chances of recession are? So if people are looking at the world right now and saying, well, inflation may be a problem, but it's not a big problem. Recession, yeah, that could happen. Then longer-term rates probably would come down in that environment. So we want to be ready for it by having money in longer-term rates, because when rates come down, you get a capital appreciation on those bonds. So that's what we're hoping and anticipating we're going to see there. On page 15, a little bit about the cash flow. So the portfolio right now generates about $1.25 million a year in cash flow. So that's a pretty healthy cash flow coming off the portfolio as well. So that's it in terms of the highlights from this. In terms of what changed in the other report, the other portfolio review, which is as of a week ago, the value of the portfolio is up a little bit. In this, on page 5, the value is up to $59.6 million as of a week ago, so it's appreciated a little bit. And I checked actually on Friday, and it had just broken 60 million on Friday. I think it was 60 million and 10,000 or something like that. So it's moving in the right direction, which is kind of nice. I won't go over the rest because it's not that different from what I just told you. On page 7, the numbers are updated. So the 12-month number as of the beginning of August was up 15.2%. The 3-year number was up to 11.11 as of August. So consistent with August having been a decent month for the portfolio, those numbers are a little bit higher than what you saw in the June 30th report. But other than that, there's really nothing that's materially different here. It's nice when saying nothing materially different means it's an improvement, which it is. In terms of where we are from an economic standpoint, obviously the first half of this year, the big news was tariffs and what impact that would have on the economy. So there are a couple of ways it affects the economy and affects the markets. The first one is the obvious one, that when you have the volatility in what's going to happen with tariffs, it kind of throws the market. And we saw that when we started down this avenue. You had days when the Dow was down 2,000 points, followed by up 2,000 points. So you had this huge volatility, and that's what we were worried about. So we figured we'd get a little bit out of the way on that. What happened over time was, I think people in the market started learning that what you thought you knew about tariffs wasn't necessarily what was going to happen. And as a consequence, instead of, when announcements came out, instead of the market going up or down 2,000 points, the market went up or down 300 points, which is less than 1%. So it kind of dampened down a little bit. And I think you got a little bit of a relief rally as a result, because people were thinking, okay, we can cope with this. And I think that's a little bit of what we've seen in the appreciation right now. Now, from a corporate standpoint, what this does is it makes it really hard for corporations to invest, because they don't know what their costs are actually going to be in 6 months or a year. And the problem is, when you're investing, you're not investing for 3 weeks, you're investing for 5 years, sometimes you're investing for 10 years. So knowing what the future is going to look like becomes important. So what's happened, and you actually see this in the GDP numbers, is the corporate investments have declined in the last quarter because they don't know what to do. So they're kind of waiting for a little bit more certainty. The irony is, when you look at the GDP numbers, you don't see it this quarter. The GDP for the second quarter was up 3% in real terms, so not including inflation. It was up 3%. So, it raises a lot of questions for people that, okay, so if there's this uncertainty, if we're not sure what's going on in the economy, how come the GDP is up 3%? And the answer to that is the following. The way GDP numbers are put together, imports are a minus. Okay, so you get consumption and investment and government spending and exports minus imports. That's the way the numbers look. So if imports go up, the GDP number gets worse. If imports go down, the GDP number gets better. So what happened in the second quarter is imports fell by 35%, believe it or not. They fell by 35%. That was a huge boost to the GDP number. It doesn't mean we're better off, but the number looks better. So that's why I would say that, look, the GDP number was 3%, but it's something that you have to understand what underpins it to understand what it means for investing. Okay, the fact that it's up 3% is actually not good because it means our imports tanked. And that includes industrial imports, not just shoes and iPhones, but it's also industrial imports. So that's not necessarily a great sign going forward. So when you put all of that together and say, okay, so what could we expect for the rest of the year? What I would say is, first of all, corporate investment is probably still going to lag somewhat. Consumption seems to be holding together, seems to be growing, 0.75%, 1% a quarter, so that seems to be holding together. Imports and exports probably will stabilize. So when you put all of that together and say, okay, what does that mean for GDP? I would guess for the next 2 quarters, we're looking at GDP to go up. If it goes up 1% per quarter, I count as lucky. Let's put it that way. So I think that we'll probably get modest increases. I don't think we're headed for a recession yet this year, but I think it's going to be modest increases from this point forward. So then the next step is to say, okay, so if the economy is going to grow at a low or modest rate, what does that mean for companies? So in the second quarter, surprisingly, I think it was surprising, corporate profits for the S&P were up 10% compared to same quarter last year. So that's pretty good. It's not as good as we had last year when they were up 14%, but 10% is pretty good. So that's the good news. Can they continue on that? On the one hand, U.S. Companies are incredibly flexible. And, frankly, the U.S. economy from a corporate standpoint is probably the best in the world at generating profits, possibly by a lot. But it's still a hard environment for them. So I would guess that that'll come down, but maybe it'll come down to plus 7 or 8%. I don't think it's going to go to a minus number. So you've got profit growth. From the standpoint of what it means for stocks in the portfolio, one, on the bond side, I think we'll get basically yield. We'll get 4%. If we're lucky, we'll get 5%, but it's going to be something like that. On the stock side, my guess is that we'll probably have a little bit of a dip over the next couple of months in the stock market as people adjust to all these factors and we figure out what's really happening with tariffs. And, right now there are legal cases which may nullify some of the tariffs and say that actually the White House does not have authority to impose these tariffs the way they have. So there's a lot of moving parts there. But I think when you look at it from the standpoint of the end of the year, the way I do the calculation in my head is I figure, well, if profits are going up at 7%, and given you have all these other risk factors, you're probably not going to get the market going up 7%, but maybe you have the market going up 5%. So I would guess between now and the end of the year, we might see the stock market go up another 4 or 5%. So that's kind of our expectation right now for the end of the year. And apart from the tariffs, the kind of things that may get in the way of that is on the employment side. Yeah, and so if you look at both the manufacturing and the services part of the economy, and the services part is about 3/4 of the economy, so that's actually the bigger piece. But the manufacturing piece is a better predictor of what's, believe it or not, of what's probably going to happen in the future. When you look at the employment piece of both of those, there's a scale that's used where 50 kind of means that you've got stable employment, the firings and the hirings are about equal. If it's more than 50, you've got more hiring going on than firing. If it's less than 50, you have more firings going on. Currently, it's about 44. So what that means, and that's both on the manufacturing side and the services side. So what that means is companies are cutting back on employment right now. So that's not a great sign. The question is, how much is that going to happen in the future? And that's something which right now, people who've been watching the new payroll numbers know that for the last 3 months, payroll has been basically flat. It's up 100,000 over 3 months, which is not a lot for this economy. Going forward, I don't think we're going to see that number go heavily negative, but it's probably going to be soft for the rest of the year, which is one reason why consumption is probably going to be a little softer for the rest of the year. And that may eke into profits, which is why I think profit growth is going to come down a little bit from here. So for the rest of the year, our sense is that it's probably going to be modestly positive with a hiccup in September, October, but it's not going to be like the first half of the year. All right.
Any questions for Eric?
I have a couple.
Yeah.
So the tariff money that's collected by the government, where does that go? How does that impact the economy?
That is a really good question. So there are a couple of impacts, because first of all, the tariff money is paid by Americans. So it's basically coming out of consumption, right? So in other words, if my avocados cost me 50 cents more, I'm probably going to buy fewer avocados, that kind of thing. So it's going to affect consumption a little bit. From the budgetary standpoint, it just goes into the Treasury account. And it looks like if the tariffs are something like we think they're going to be right now, it could be $300 billion this year. So that's a plus. On the other hand, we're running deficits right now, which are projected to be about 1.7 trillion. So it could be 1.4 trillion instead of 1.7 trillion. In the big picture, does that make a difference? Maybe not.
Okay. Further, I guess what I've heard is the big problem with tariffs has been the uncertainty. So maybe some of those things are starting to get resolved with these
Yep.
with these agreements that kind of establish something that people can at least know what it is for a
Yep.
longer period of time. And so I think you kind of alluded to that. Some things are settling out because of that. People maybe can make longer term commitments or things
Right.
now. What portion of any of this do you attribute to AI in terms of the economy? In terms of the employment numbers and that, is that something that you're looking ahead? I know they're talking about that is impacting things, and maybe it's not quite here yet, but it's coming. And curious if you have any insights on that.
That's the key. It's not quite here yet.
Yeah.
So I think you've probably had minimal job loss from it currently. I would guess that you'll see more over the next couple of years, but it's going to be a slow process of, getting involved. Did you
Yeah.
want to say something about
I've been
that?
kind of obsessed with AI for a while now. So my impression is that it's definitely impacting certain jobs already. Like if you're a coder, it's very tough to find an entry-level coder. It's very tough to find a job. Paralegals are having a hard time. A lot. So I think certain things it does well already. It's kind of impacting certain jobs. I mean, there are a number of companies aren't hiring the way they were even a few years ago. Going forward, I think my impression is it is definitely going to have an impact on see, like everything sounds kind of up to date. I don't want to exaggerate, but it's definitely have an impact going forward over the next 3, 5, 10 years. Things may be quite different. We'll see.
Thank you.
Alderman O'Brien?
Yeah, I asked this question not to be political, but the President of the United States fired the statistician that came
Yep.
out with the unemployment.
Right.
And your industry has, as through your presentation to us, has to rely on these numbers.
Absolutely.
And it was a bloody miracle that only occurs at 1600 Pennsylvania Avenue, that once the person gets fired, the numbers all of a sudden radically, and thank you, Jesus. But is that true? And is that going to affect future investments here? Well, when you're trying to come to us and tell us, what's happening here.
What we don't need is uncertainty about the numbers.
Oh, it isn't true,
Yeah,
yes.
exactly. So I think it will affect things like investments. What happens at Bureau of Labor Statistics going forward, nobody knows right now, because the reality is, first of all, firing her didn't have any effect on the actual numbers, because she doesn't produce the numbers.
Right.
Right? There's a group of literally hundreds of people who collect the information, generate the numbers. She sees the numbers for the first time 2 days before they're published. And her role in the process is to wordsmith the press release. That's it. She has no control over the numbers. So if that continues with the new person, then we're okay. They can say what they want, but the numbers will still be the numbers. If they change the way the BLS works so that you have political involvement in the generation of the numbers, that's another thing. And then we're on really dangerous territory, because then it's the question of what can you rely on?
And a follow-up, if I may, that could destabilize
Yes,
these pension
Yep.
programs with us.
yes, because then we're in a world where, some important numbers we can't rely on. Yeah.
Thank you.
Thanks for not getting political. Any other questions?
It's a legitimate question. They're Canadians. They're all right.
A question around some of the numbers being more estimated based upon cuts in the government. Is that true? Like, are there some areas that they're being forced to estimate numbers versus getting a little bit more in detail around the actuals?
The short answer is yes.
Okay.
And the question is, to what extent? Because when they do that and they estimate numbers, first of all, there's always going to be an estimation process, because you can't collect all the information all the time.
Sure.
So what they do is they try to minimize the impact by keeping the employees focused on the more important parts of the number. But you are going to get some wiggle room. And by the way, in that context, let me mention, it's not just them, it's also just the way numbers are collected. So a question that gets asked occasionally is, okay, so how come the previous two numbers moved by 250,000?
Right.
Because that's a lot. That's a big movement. And the numbers always change, but 250,000 is a lot. And so in collecting the numbers, what happens is it's all done by survey. And companies are supposed to return the survey within a certain amount of time. They don't necessarily. And my guess is in the last quarter, they had other things on their mind. So there might have been an excessive number of companies that kind of slipped the deadline. And that's basically what happened. The most important reason you get these revisions is because they get late information coming in from the companies. That's not going to change in the future. Maybe it won't be as big as it was this time, but you're always going to get that problem. And that's you can throw more employees at the problem with BLS, but apart from calling companies and saying, where's your survey, there's not a lot they can do about it.
So when they take a survey, or the survey's late, do they rely on previous numbers to try to estimate? Is that how it, do you have any
Yeah, they
idea
rely on previous numbers and they rely on what they have.
what they have?
And if, sometimes you get systematic biases, right? So in other words, it may be that a company is late because they really don't want to say that they lost 30 employees. So they kind of, kicking the can down the road a couple of weeks, that kind of thing. So it may be that the late surveys happen to have more discouraging news than the ones they got early. That may be what happened.
That's what we probably saw.
Yeah.
Any other question? So are you gonna,
Yeah.
are you talking about the actual report or something else?
Okay, so I had sort of planned on talking about this, the state and local comparison document. However, I can do a little bit of both, especially since the sort of, so if we look at, maybe I
I
can
just
do
want,
them
before you start.
at the same time. Yep.
This actual report, I've been out of this for a couple of years, but
Mhm.
this used to be done every other year.
It still
Is
is.
that still how it's working?
Yep,
And they do like a shorter version on the off year?
yes,
So this was done in '24, apparently.
based on 24, yeah, based on June 20.
I had not seen this. This must be been out for a while, I would think.
It came out for a little while. I believe there was, there was a little bit of holdup, I think, because in the interim number that came out, we noticed that there was some mistake, and then so they had to go and do some revisions and then probably and reissue. So I think it was a little bit delayed. Although, in truth, even in years where it wasn't, a lot of times the full report would come out. Although for June, it would come out sometime around the beginning of the year. So.
So these have to be put in the city audit.
Mm-hmm.
They do look at
Yep.
this, I know that. So.
Yes, I mean, this, with regard to the accounting and the audit, I think this is kind of the reference.
Yeah. Okay, you can start with where you like.
Well, okay, so let's look at page 2 of the plan comp. That's like the page 2 of this one.
This one is a little short presentation.
State and local plan.
Yep.
And we can also look at page 1 of the actuarial report, because that kind of has the rundown where the numbers on page 2 came from page 1 of the actuarial report. And that we're doing them at the same time isn't coincidence, because over the years for Nashville, what we've done is when the actuarial report comes out, we look at those numbers, and then we also try to put Nashville's plan in context to how as a muni plan, how is it doing with other plans around, municipal plans around the country. And so when we got a hold of the actuarial report, I went ahead and put together the plan comparison report. So for context, if you're sort of looking at page 1 of the actuarial report, the first line, number 1, actuarial accrued liability, this is 58.3 million, and that is the number going forward in order to pay the benefits for all of the people who are already retired and the people who are working. That's how much money the plan needs to pay, based on the actuarial calculation, to pay the benefits going forward. The second line there, the actuarial value of the assets, 51.6 million, is the actuarial valuation of basically the plan assets, which are mostly what we have. And to note about the actuarial valuation, it's different from the market valuation. So when the actuaries smooth the asset values over time, these are like a 5-year smoothing period. So the actuarial value of the assets will tend to lag the market value of the assets. And they sort of work in it over time. And since we've had some pretty good years recently, 2022 except with the exception, we've in June of 2024, the market value of the assets was like 54 million, as opposed to the 51.6 there. And so there's, again, because of the lag in the actuarial value versus the market value, those things are sometimes off a little bit, but there's and there's a reason for the smoothing, because they use the actuarial valuation to figure out how much the city needs to pay, and so you don't want if the market value is bouncing around with the stock market, you don't want to have the city payments bouncing around too much as well, so it smooths it out. That's for the reason. And then so line 3, the unfunded actuarial accrued liability, that's just the difference between those two numbers, 6.7 million, and then the ratio of the assets to liabilities about 88%. Okay, that's based on the actuarial asset valuation. Based on the market value in June 2024, you are at 88%, you're closer to like 92% funded. And then looking at June of this year, if the liability itself hasn't changed that much in the last 12 months, we're pretty close to 100% funded. We have like 58.4 million, and the actuarial accrued liability is just about 58.3. So basically you're just about 100% funded, which if the committee were so inclined to make a payment, in the future, we can go with this into a little more detail, but you have a little wiggle room if you want to make potentially some extra payments to the beneficiaries, the retirees, or
like a one-time stipend.
something like that.
Right.
Yeah,
We've done that in the past, yeah.
Yeah.
mm-hmm. So there's a little wiggle room.
The last time we did it, it had really hardly any effect on the actuarial. I know that.
Right.
I think we gave 1 month's,
Kind of depended on the year,
Yeah, it
how long they've been
Yeah.
retired.
Mm-hmm.
The longer they were retired. the
oh,
better.
yeah, I mean, right.
Mm-hmm.
Here for 30 years is different than 15 weeks, but, yeah.
Yeah, and then how long they were, and the longer, because there's no inflation adjustment to the payments.
Yeah.
Someone who retired 20 years ago, their inflation adjusted benefit is quite small compared to someone who retired 3 years ago.
Mr. Chairman, if I may,
Yeah.
to that point that you're talking about, it would be my goal. I'm underneath the state pension system, and depending upon the state legislators, when we get a COLA,
Mhm.
seems to fit around a particular political party. It stinks. I've been out over 10 years and never received a COLA, so I think
Mhm.
that's, we'll discuss my opinions later on that. But, however, the thing is there a way that we can look at that, with a little Christmas bonus at the end of the year or something like that?
If you'd like to, we can do
Want
the analysis.
really to hurt
Yeah,
us.
Absolutely. Yep.
Well, the plan is to do a stipend this fiscal year 26, that started in July.
Okay.
Mhm.
I'm not sure if we'll be ready for Christmas, but
Well, if
it's a lot of work.
If I can refocus
Yeah.
to my question, is basically, how long can we do this? Are we sustainable enough to do this? And when should we do it? When do we start losing ground on your pension? You know what I mean? Is it 5 years out, 2 years out, or 10 years out,
Some of that is unknown. It
Yeah.
depends on what the market gives you. But what I would say is, given the scale you're probably talking about in terms of what the stipends are going to cost, currently you've got, as of Friday, about 60 million in the plan. If you were to nick that for, I'm making up a figure here, 300,000, Would that be material to the plan? Frankly, no.
Okay.
Right.
No, yeah, we are gonna work on it.
Yeah.
Right.
Yeah, and it'll be singing
I
our names in
personally
the
don't,
street.
I don't support an increase every year.
Right,
Right.
I've seen what happened to the state
yeah,
when
Yeah,
they used to do
exactly.
it.
exactly. Yep.
And
Yeah, you can
they're
get
not-
yourself
They're not
into
90%
trouble.
funded,
Yeah,
No,
no way near that.
right, exactly.
So,
Right. No, it is, having a built-in
the other
automatic
thing that
coalescer.
happened,
Yeah,
I think that happened good this year was that Fairness Act that passed at the end of Biden's term.
mhm,
So I know a lot of the long-term retirees in the Public Works plan all
Mhm.
got social security bonuses that they
mhm.
didn't have any idea that was coming.
Oh,
Right,
nice.
right,
You know, their social security increased
Yep.
every month, plus they also got a bonus, a whole
Mhm.
12-month bonus.
Oh,
Right.
wow.
So that happened to a lot of people, but
mhm,
Public Works also fell into that.
Mhm.
yeah,
So they were all they're pretty happy about
yeah.
that
Oh, good.
anyway, so.
Yep.
Okay.
Yep.
Any other
Okay.
questions?
So, yeah, that was a sort of a tangent there. And that's kind of the core. So when you look at the plan and sort of the health of the plan, you want to look at the sort of what they call the funding ratio. So how much do you have the assets to cover the liabilities? And so if you're close to 100%, that means at least by one measure, yeah, you're pretty good. And so our discount rate is 7%. So as long as we can keep making our 7%, and we've done that, or in the license since we've been handling the money. I think the inception was like 7.8 or something like that. Is that our rate of return from inception?
Mhm, yep.
So basically, we can keep making that 7% over time. I think we're in a pretty good, we'll be in a pretty good spot from an asset and liability funding ratio standpoint. Okay, so that's the context for where we are, and just to kind of give a sense for where Nashua fits relative to plans around the country. There's a couple of sources for information that we use. One is the U.S. Census. So on page 3, there's a set of, we used a set of plans looking at their asset values and their liability values, and then calculating the funding ratios for the plans in the U.S. Census, so the municipal plans and state plans. They answer surveys again, and the U.S. Census collects data on the plans and publishes them. And so, of this subset, most of sort of the larger of this survey, the median plan had about $100 million, which is a little bigger than Nashua, and then some of them went up to into the billions of dollars. So our of the median plan in so the median funding ratio in the plan was like 81.6, whereas again, this is using the Nashua's sort of market value assets, because I was using the market value of the assets when did the analysis. So looking at Nashua's market value of assets versus liabilities, and Nashua's 92% was better than 72% of the plans in the survey. And for context, that's Nashua's discount rate of 7% was slightly higher than the median discount rate of 6.9. And then there's we could have a discussion about the discount rates, but I think what you should know is that if with a lower discount rate, it makes the liability a little larger, and the funding ratio would be a little smaller as a result.
So we're in the top quarter of all these plans?
Yes, 70. Well,
Just about
70, almost 72.
percentile.
So it's top,
Close enough.
Yeah,
close to the quarter. Yeah.
yeah,
So for that set of plans, and that's there were 521 plans in that portion of the survey. If we look at plans to sort of focus on a
So this is
subset of the
page
plans.
4
Sorry,
now.
page 4, yep.
Yes.
A subset of the plans with assets that are closer to Nashua's, so basically plans between 20 and 80 million. So just a smaller set. In this case, and for that smaller set of plans, there were 115 in that group, and Nashua was in the top quarter at around 78% of, better than 78% of those plans. Again, but also just as a caveat, so the discount rate, the median discount rate was like 675, so versus Nashua 7, which at 675, Nashua would be a little bit, the liability would be a little higher, sorry, and the funding ratio would be a little lower, but that's the context is you're, given the census, survey of the census municipal and state plans, you guys are in pretty good shape, relatively speaking.
So the takeaway is if you compare it to other plans of similar size, you are in the top quartile.
These are,
Yep.
these are not all in New England, there could be states.
No, it's national.
Just the size.
Yeah, that's
National.
right.
Yep. Is there any, do you know of any that fall in this plan from New Hampshire?
I didn't
See any?
specific, oh, well, I mean, I'm sure that they report.
Well, Manchester has a partial of their own plan too, but
Okay.
theirs is a lot, they have like, I think, $300 million versus, it's a
Okay.
bigger plan.
Yeah.
Mhm.
They cover, I think, most of their employees except teachers, police, and fire.
Mhm.
Okay.
So it's different.
Yep.
It's a bigger plan.
Yeah, I didn't,
And I think some of the towns in New Hampshire have their own plans too, but they must be much smaller.
Yeah.
Yeah.
Anyways, well, that's good. That's
So
good
again,
news. Any
yeah.
other good news?
Well, okay, so the other source is, there's an organization called Public Plans, which it's hard to, so in this organization, Public Plans, they collect data from mostly just the largest public plans, so looking at page 5.
Yep.
So we're, in this case, I mean, really the largest, like the state level plans or something like that. So within this larger set of, the plans with larger assets, so the average asset was like almost like 27 billion, and the median plan was like 10.8. So again, very large plans, like we're talking like CalPERS or some of these other ones.
Pensers, plans
Yep.
like that.
Mhm.
Yeah.
And so, looking at sort of just comparing Nashua's asset allocation compared to these, again, the largest public plans, the largest public plans over time have sort of reduced their equities and fixed income and increased their allocations to commodities, hedge funds, commodities, other alternatives, and sort of more illiquid investments. Not all of them have, with the exception, some of the largest ones even are getting out of those allocations, but that seems to be the trend among some of the larger plans, is to try to capture some additional return for investing in assets that aren't really liquid. In other words, they can't really sell them or easily, but if they plan to hold them, then there's some theory that they maybe have some additional return, although oftentimes theory and practice don't really match up. And which is why we tend to keep you guys in stuff that's pretty simple and liquid and easier to manage.
So let me interrupt for a
yeah.
second. So just a little bit of gossip from the industry. A lot of the large pension plans are trying really hard to cut back on private equity. And the reason is basically it's two related things. One is they've been disappointed in the return on private equity compared to the public markets. And part of the reason for that is because over the last 10 years, the private equity field has been saturated by money. So if you've got a private equity fund that's $1 billion, that's a small fund now. And so you've got all this money flooding into private equity, and the opportunities aren't increasing. So the rate of return has to go down. So the gossip in the industry is you've got a lot of these pension plans like CalPERS, for example, and Pensers that are trying to reduce their exposure to private equity right now. And of course, the real estate piece is, a sometime thing, right? Sometimes The real estate market is really good, and sometimes it's not so great, so it fluctuates a lot.
Sure, and Manchester's the hottest real estate market in the country,
Is that right? Wow.
according to the news
All right.
anyways,
Wow, all right, well,
unlike Florida.
Yeah.
That's good.
yeah, Florida's got their own, they have their insurance problems.
Yes,
Yeah.
I know.
Yeah. Okay, so that's page 5. Looking at page 6, again, for that same set of large plans, there is the top graph shows the sort of returns per year over time, as well as that the orange line there is the assumed return versus the actual returns over time for the largest plans. And you can kind of see in, well, you see, like 08, 09, there was the big financial crisis, there was a lot of loss, and then that is actually, to a great extent, that's what triggered some of the movement from regular assets into the hedge funds and private equity and some of those other things over time. 2021 was a very good year, and so 2022 less so, and we're, I think, over you know, for the industry broadly, that's led to some increase in the funding ratio, which is also below, you know, earlier. So at one time in, you know, 2021 or so, most of the plans were listed as 100% funded, which after a couple of series of underperformance from the market, you know, and we had first we had the dot-com crash and the financial crisis, and then to some extent we have the 2022 left over time left many of the plans closer to 70. Let me see. What is that? About 76 or so percent funded for the average of the large public plans. So even the large public plans are still only about 76% funded versus Nashua's. These are actuarial funding. So going back to Nashua's actuarial funding ratio around 88%. You're still in a pretty good spot compared to those plans. And that is about that. Any questions?
Know about that? Good.
Okay.
Do you have another section you wanted to talk about?
That was.
Well, that was it?
That's
That was it. We touched on a little bit about the terms of the stipend, and we are absolutely willing to help model different, you know, how much it would cost for the plan, potentially for depending on the formula used and how much you wanted to do. But what I would need, because I don't have information of the demographics on the retirees. The actuarial report has some information on the demographics for the active employees, but not so much the retirees. So it would be just a list of the retirees, no personal information, no names, definitely no social numbers, social security numbers, just like when their what their benefit amount is and how much
Age and when they retire.
age
Yeah,
exactly.
we still have
Yeah.
the last time it was done, we still have that whole system. So
Mhm.
we just have to be, updated.
Okay. Yep.
For all those different sections, but.
Yeah. So that would be to the extent that could be helpful. Absolutely. Let me know.
Okay. Anything else you got, or?
Just one miscellaneous thing I'll mention, which doesn't actually affect the pension plan, but, may be helpful for the city. RBC recently launched what they call premium savings program, and it's like a money market, only it's FDIC insured, and it's currently paying 4.23%. So there's a $100,000 minimum on it, so it's kind of more institutional than not, but just wanted to mention it in case it's of any use to the city.
And
Yeah.
I think that rate is locked in for a year. So
A year?
Yeah.
Well, they have a deferred comp in the city, but, and and they used to have a section that was 4%,
Uh-huh.
but I don't know, I'm not,
Yep.
not
Mhm.
really, I'm not sure if that's changed or
Yep.
anything.
Yep.
Um,
So,
Okay, any other general questions? I have a couple.
Oh.
Do you want to stay for the whole thing, or after this, are you fine?
whatever you like.
Yeah.
Yep.
Well, I wanted to ask you a couple questions on, at least one or two.
Mhm.
You know, we had that RFP process
Yep.
recently, and you had sent several emails, maybe 6 weeks ago,
Mhm.
2 months ago, I can't remember
Yeah.
exactly. I want to make sure, because I've heard different stories. Apparently, you had missed 2 items
Yes.
in the submission. Did you ever hear from anybody here in Nashville, the city, that you were missing something, or?
No, we got no communication. In
Are
fact,
you
we
sure?
sent.
No
yes,
one in your
Absolutely
organization?
certain.
No one in your
there wasn't.
organization?
Yep.
There was none.
Yep.
We talked.
No, that's not what we were just told by
Yeah.
purchasing.
And we sent an email around the time when the finals were going to
Yeah.
occur, just asking what the situation was, and got no response.
Nothing, okay. Did you have any?
No, I just, one of the things, though, through the RFP process and us doing, as a board, doing the due diligence for us, sorry, committee, board, pension board, yeah, is that we continue to follow up on things like management fees.
Yep. Absolutely.
That we're
Yep.
continuously doing our due diligence to see whether or not we can decrease it for the purpose of better output for this pension.
Great.
So I think in the future, we have to kind of take some of this back, but we wanted to put that on your radar.
And we're open to that. We've reduced the fee already to the 35 bips in our proposal. And, the irony in our position is we probably know less about competitive fees than you do, because we see our own proposal, and it's rare we see anybody else's.
Sure.
So to be blunt with you, we kind of guess where the competition is, and that's all we can do. So as a result, we're certainly open to being flexible. If we're not where the market is, we would want to know. The one caution I would throw in is that different places frame it differently. So you get some places that use, for example, outside managers. So they'll say, well, our fee is 15 basis points. Isn't that great? And they're not including in that, because it's not part of what they get paid, that the manager is charging 25 basis points. So altogether, it's actually 40, even though your advisor is only getting 15 of it, whereas we're basically doing both jobs.
Makes sense, yeah. This is part of our due diligence that
Yep.
we have to do,
Yeah.
but
But
appreciate you
if
being
we're
open
off
to
the
it.
market, please let us know. We'll analyze it, and we'll come back on the market.
Great, thank you.
Yeah, we'll
Yep.
send you some
Yep.
information.
Yep.
Yeah.
Yeah.
But this is a great return, right?
Oh, yeah, it's very good.
It's excellent.
Very good. Any other questions? Anybody? Okay, well, in the number 2 expected visitors, we went through that. We'll go through the regular agenda.
Mhm.
That's okay.
Yep.
Shouldn't take too long.
They don't have to,
You don't have to stay, it's up to you.
Okay.
not that
If
interesting.
you want to leave,
If you don't need us for it.
you might want to go to lunch.
You can hear about our IRS ordinance changes.
Yeah, if you can send us the data, and if you have even, a concept of a plan in terms of what you'd like the stipend to look like, let us know, and we'll analyze various options for you and cost them out.
Michael, is your offices still at Exit 8?
Yes.
They are,
The Founders Work.
yeah.
Okay.
Take them to the new Italian restaurant there.
They've opened up a couple good places out there.
Yeah, I know, there's always something opening.
Yeah.
All right,
All right.
thank you very much.
Well, thank you.
Yes.
Thanks for having us here. Yeah.
Anybody want a break or anything, or no?
I'm just gonna grab a mic. It looks like both these are dead over here.
Oh, really?
Yeah.
Check that out. I don't even know if they pick us up really that quick, I don't know. I never watch these on.
Why are the, normally there's green lights on those. Oh, there's one there.
Our copies of the,
Yes.
how many would you like? We probably have a copy of those.
Yeah, we won't probably want, I think Joanne has one, but she probably needs one for Dawn. And we have a couple people missing.
Yeah.
Yeah, so at least 4, maybe?
Yeah,
That-
four.
4?
I'd like it, yeah.
Oh, yeah, you, one can go to Joanne for sure.
Yeah.
Yeah, I'll take them. Thank you.
Thank you.
Thank you.
All right.
Thank you.
Thank you. Drive safely.
Thanks.
Oh, they're going back down to New York.
I don't know if they're going today or not. I think they must be. They have to get their New Hampshire shop.
David, I'm curious, what did Tracy tell you, because that's not what they told us?
It came right from Dawn, when she talked to me the last time I met her, that someone was informed at the company.
That's not what I
Well,
was led to believe.
No.
I heard that very
I heard it
clearly,
too.
so.
It's probably in these minutes.
But anyways, why, yeah, I don't know if it was in the minutes, but
Yeah, I don't know.
when I saw her in the office is when I heard it again, so. So we'll go back to our agenda. We have number 3, minutes of the meetings for the June 2nd regular meeting and the June 12th special meeting. Were there any discussions on that? Is there a motion to approve?
I have a
Oh, I'm sorry,
discussion.
Dan, yeah,
Yeah, just in the minutes on the top paragraph, page 4,
hold on.
for
The 4 out
the
of
June
5.
12th meeting, just to our recent point, it talks about, she will go back to purchasing manager and make sure that we did do everything we could. RBC, non-response was on their part, not on our lack of offer. She will report back to the board. So basically, that was kind of the discussion we had, that RBC had not responded, I think. So I was just pointing attention to that. I have no issue with these minutes.
What is this? Oh, I see, yeah. No, I'll try to get clarification.
Yeah.
Anything, was that it?
That's it. I was just drawing the board's attention to that. If there hasn't been a motion, I make a motion to approve the minutes.
Of June 2nd and June 12th?
Yeah, I'd be fine with that, yep.
Okay, second?
Second.
Oh. Matt? No discussion, all those in favor say aye.
Aye.
Any opposed? And that motion carries. Personnel, we have the retirement of Amy Gill and Mark Jennings. We have the information here. Is there any discussion on it or question?
I just want to say these are two good employees. They're both from engineering. Amy was
Yeah,
with
I
the
know.
city 23 years, and Mark was 11 years.
Yeah.
This paperwork takes a while to get through to us, I guess. They both retired in April. But yeah, there's good employees is all I want to say, and we miss them.
Okay, any other discussion? If not, all those in favor say aye.
Aye.
Opposed, and that motion carries. Update ordinances, well, that's part of, under new business too, so. We have 2 invoices, I think, from McLean Middleton. One for $1,560 and the other for $2,015. One of them is related to his support for the ordinance change we had done in June. So, are there any questions on that? If not, is there a motion to approve?
I'll make the motion.
Seconded by Matt. Second. All those in favor?
Aye.
Opposed, and that motion carries. Then we have an approval of a USI invoice for pension actuarial consultant fees. Again, any motion on that?
I'll make the
Brian,
motion.
Seconded by Matt. Any other discussion? If not, all those in favor say aye. Opposed? That passes. Approval pension benefits Mrs. Judy Toomey. That, once the board finalized the approval of the change, Joanne worked to come up with the new numbers, and that was sent to USI right? Is it USI, is USI is what they call themselves, right?
Yeah, U.S. company.
We have not sent it to USI yet because the board has to approve it first.
That's true, sorry, yes. So, we have a, let me find it. I'm gonna just look at their numbers, make sure. All right. Trying to find the sheet that has that in it.
It's the last.
It's the email at the end.
Oh, that's the thing we just got today, isn't it?
Mhm.
Yeah.
Yeah, it's like back. It's,
So, currently, she's collecting 1611.35, right? With the adjustment, it would go up to $2,644.19. You hearing that? Okay. So, there'll be a retro, and then she'll continue to get $2,644.19, starting in September. So it did make quite a difference. Thank you, Joanne, for doing this. Is there a motion to approve?
I'll make the motion to approve.
second.
Yeah. Any other discussion? If not, all those in favor say aye.
Aye.
Against? That motion carries. All right. I'm losing all my papers for some reason. So we did that.
We have the rest of
Yeah, I don't know. We got some today that were old. Is that because they just took time to reply back on these? Most of them are people who just had a couple of years or a year's service.
We didn't have a meeting last month, so there was a lot.
Wow. This person left in September. I mean, these are old. But anyways.
Right, but a lot of them, the paperwork sits in the persons, they don't respond.
They don't respond.
Right.
Okay, so is one for Jordan Gay, I think if you pronounce it. He was here for a short time, so he's just getting his contributions back. And then there's an Adam Nato, I think it's the same story, wasn't here very long. And Brian Palmer, same thing, wasn't here too long. And then there's Alexis Cruz Gonzalez, I think. And it looks like the same thing, he wasn't here too long, so it's just a portion of his contribution. I think that's it, right? Oh,
Well, I was just going to say, I would like to make the motion
yeah.
to approve Mr. Gay, Mr. Noto,
NATO,
Mr. Palmer,
yeah.
and Mr. Cruz Gonzalez.
All right. Thank you. Seconded by Matt. Is that it? Joanne, I'm not missing any yet, right?
No.
Okay. Okay, any discussion? If not, all those in favor say aye.
Aye.
Opposed, and that motion carries. And we did Judy's already. Goals for fiscal year 26, I put those there. As you know, we're still doing the major IRS changes to the ordinance. And I'm hoping that we'll have it totally finished and approved by the board by December 25. The other item is the one-time stipend I put by May 26th, but I like to do it faster than that if possible.
Do we have to vote on that?
We will have to vote on.
Okay, that we're going to do it.
Well, I don't think we've been that formal, but if you want. But
yeah.
these items, the IRS changes would have to be approved by the Board of Aldermen.
Right.
So would the one-time stipend have to be approved by the Board of Aldermen.
Okay.
But if you want to make that motion, that's fine.
I mean,
I would,
Sorry.
might want to wait till.
Just point of order, yeah, it's been a while since we've done it. I want to see what the formula is and
Yeah.
that sort of thing. I mean,
Sure.
I'm fine. I would vote for exploring the idea, because I think the financial results continue to be good, and things, it seems like a good time to do it. But, yeah, I want us to spend a little time so I understand what we're doing.
and that's what I would suggest too, is that this would be a
Yeah.
formal formal
Yeah.
review.
It would come, oh, yeah.
Thank you.
I was going to say, when do you want it back? Because what is our goal to issue that out? Is it going to be like the 13th check, like, within this fiscal year, Christmas bonus, so to kind of speak, or you're going to drag it into 26?
This is by May 26th.
26.
Yeah, that was my estimate.
You're going to go with 26?
Yeah, but if it gets done earlier, we'll just bring it forward. It's a
Well,
lot
yeah.
of work.
I kind of like the
Yeah, you
the
like the Christmas.
Christmas part of it. It kind of makes the cockles of my heart feel good, but-
They can pay off their Christmas credit card in January.
Well, there you go. True.
We'll see. Depends how much time I have to work on it, too. Anyways, so we can make that more formal when we get these. All right. This period for public comment, but we don't have anybody here. Items by trustee. Dan?
Just refresh me where we're at. There was a letter that was going to go to all, not retirees, but basically about the portal. I didn't bring a copy, but I believe I got a letter at home, but it did not come with a PIN, so I could log in. It just said reach out to the entity that we have a portal to set it up. So it wasn't what I was expecting to get. I don't know if that's what everybody got. But I to date have never logged into the portal. I was expecting to get a PIN, and that was going to be easy for me to go on and automatically sign up, and that's not what I received unless I missed it. To my understanding, that's not what I received. So I was just curious if we have copies of the letter that went out, or.
My understanding was if you had opened it before, you weren't going to get the PIN, but if you had it, they were going to, is that what they were doing?
Yes, if you had already signed into the portal, you have a PIN and had probably reset it. So they weren't going to be sending that information out. It was for people that have never logged on, which is the vast majority.
Right. Well, I'd just be curious from one of the other members. I don't know if we heard from any. I didn't get a PIN. I believe I never signed on, although I was issued a PIN with my onboarding, as a new employee. So I don't know if they think that means I didn't need another PIN, but I can't find that paperwork either. But so I guess I can ask around. I just I didn't get what I was expecting to get anyway from my.
They were clear on that letter. They were, people who had used their PIN at least once was not going to get another
Yeah, okay.
PIN.
So
So that must, you must.
I'm forced, I'm forced obviously to reach out to them because I didn't get a PIN. So I'll do that. I'll see what I learn. I'll ask around to other employees to see what they received and report back next
You
time.
don't think you ever used the PIN at the beginning or anything?
Have you tried to sign on? Is there like a reset, like with you can use your social security or something?
I have not, but other people that I understand, well, I have not, so I will try that. So I'll report back next time. I guess I didn't come prepared, obviously, with the information exactly, but I just recall when I got it, it wasn't what I was expecting to get, so I was just curious if others did the same, but I can ask around.
Do you hear anything?
Oh, I went on, shut right down. Yeah, I couldn't go nowhere with it.
You couldn't?
But because I had the original piece of paper when they sent it, when nobody told us it was coming, and that was many years ago, and I can't find the paper, of course. So I might have done it many years ago, but my memory is not gonna, so. It's one of those ones I'll have to make the phone call and just do it through the phone call, which try to
Try
avoid.
that, but let us know how it goes.
Yeah, yeah.
Seriously, please.
It ain't
please,
nobody else's
serious.
fault. Like I said, I could have done it way back when, and of course, I save every piece of paper and I can't find the one I need.
Yeah, join the club.
Yeah.
Okay, any other items by trustees? I think we probably should, somewhere along the line, talk more about the fee.
Mhm.
I think we can get that down, definitely.
Yeah.
Okay, any other discussions? Is there a motion to adjourn?
I'll make the motion to adjourn.
Seconded by Matt?
Matt.
Okay, all those in favor say aye.
Aye.
Thank you.
That's my favorite motion.